Good morning and welcome to CFRA's webinar on asset management and wealth management trends. I'm Ken Leon, Director of Equity Research, and with me is Kathy Seifert, Vice President and Senior Analyst in Financial Sector. Today we're going to be covering two, I think, very interesting industries that are dear to many of the registrants on the call, financial advisors. Moving to slide 4, a familiar slide we use in our webinars, you can see the history of CFRA. Over 90 years of innovation and growth, we have grown to one of the world's largest independent research firms with 75 professional analysts, and the business has become dynamic over the last couple of years with the acquisition of S&P Equity and Fund Research in 2016, the acquisition of First Bridge Data for our ETF platform, and of course our world reputation in terms of forensic accounting. Moving to slide 5 highlights the engine of our research for both fundamental equity research and also the forensic accounting research teams. Many of you as subscribers are seeing research that cuts across equity market outlook commentary, which is Sam Stovall, Sector Watch, our analysts who are publishing on industries with industry surveys, as well as our ETF and mutual fund research from Todd Rosenbluth, who heads up our practice there. We offer quality and importantly scale, covering over 1,500 global companies for fundamental research. And the secret sauce for CFRA is not only distilling our research insights, but delivering performance in our recommendations. And it's that DNA of collaborating across fundamental and forensic accounting. Very exciting where we are today, and certainly where we're going over the next 6 to 12 months. Looking at slide 6 is recently we launched our new API research solution. It's called Research as a Service. By the way, an API will be part of my discussion in the wealth management section, which is application program interface. And given the ability to use technology, we were able to create a cloud-based research experience for financial advisors. The offering is at the enterprise level for either web or mobile, and it's a suite of tools that we're excited about that's called an Idea Generation Hub. It has screener and research dashboard capability. It's part of that advisor workflow to create really knowledge, but also efficiency. And we think it's going to enable advisors to focus more on their clients, spend less time mining research, and having it, if you will, at your fingertips. We were pleased to be recognized as in the Wealth Tech 100 for their 2020 list. Finally, kind of our core values on slide 7 is our independence. And research is all we do. We are an independent research provider that invests 100% in our research. We are really free of conflicts that may arise in asset management. And certainly we're not a broker dealer or investment bank. So we are really confident that we can be agile, fast, and hopefully ahead of the curve in serving you. So let's go to today's presentation. Moving to slide 9 on wealth management. I will go through this part of the discussion, then Kathy's going to pick it up on asset management later. Well, here we are almost in June, and COVID-19 is deserving certainly to be the first slide. And the takeaway of that is growing demand for financial advice. In the dark days of late March and April, there was a survey done by the Certified Board of Planners, published in Investment News May 4th. So let me quickly give you the takeaways about financial advice. Top client concerns, obviously, had to do with market volatility that scored the highest, the question of protecting your assets. Hopefully that didn't mean selling your equities and going into cash. Some concerns for liquidity, particularly for those customers where there was layoffs or furloughs that alarm them in terms of their cash flow. And of course, concerns of not only what is happening to me now in the near term, but what could this mean for my plans for retirement or for college funding? The advisor's response, we're talking about well-experienced professionals, was to sit tight, rebalance portfolios, update your investment goals, and of course, to continue to invest in equities and be diversified. The other challenge through this was staying in touch with clients and having frequent dialogue. A big aspect of this is the emotional impact that they were seeing from customers. And at the back of the mind of advisors, of course, is not only serving current customers, but growing a book of business, and doing this situated mostly working remote, and then looking at the work-life balances. Many advisors still have children at home or other issues. Slide 10 is really the theme for my presentation, is wealth management responding to a changing world. We have seen enormous impacts as it relates to wealth management. What we will try to address over this presentation are these questions. First, how financial advisors are communicating with their clients. What are the market channels and segments? How are they changing? Are they converging? What exactly is the wealth value proposition? It's not only across investment products, but then it's also in terms of thinking about the different segments or channels that you can deliver investment advice. And additionally, technology is right in the center of the bullseye of really new entrants and disruption. And I'm actually pleased to be talking today versus maybe 5 years ago, because when I think about incumbent banks, whether it's global investment banks or large brokerage firms, they are succeeding in defending their wealth franchise. Slide 11. Some of the key factors that we're looking for in 2020 from the perspective of the large investment bank and brokerage. First, again, is today we are seeing integrated banking wealth management practices. The managements see this as a unique competitive advantage to really scale these relationships. And we'll be talking about how these ecosystems are enabling them to drive growth in the future and to have an early move advantage even over a new startup, perhaps in fintech. I would note, and we will get into, that all banks are not the same. Their strategic view about wealth management may be different, strategies are different, and where they are today and where they want to be tomorrow. So the importance of wealth management does vary. As an analyst covering the large banks, it's obviously filtering this into their total revenue and profitability. I would say that generally wealth management is embraced, and the segments that they're looking to expand, depending where they are, ultra high net worth, the traditional area for advisors is high net worth, and then the mass affluent. And then the investment advice really is beginning to use the flywheel of more technology. Firms are making sizable capital investments in technology. We are seeing the high net worth millennial households, it's a generational behavior. They're looking for more digital connectivity. It's no different than buying a new car. They're looking to have more access to information besides speaking to advisors. And ultimately, execution matters the most. You can put lots of capital resources, you can invest in technology, you want to drive your brand and customer experience, but you have to execute. Whether it be the product roadmaps, a new platform, or telling advisors what they need to do. And that possibly will be the difference on winners and losers, both for firms and for advisors. On slide 12, higher velocity of change, and I could say it's technology. And we break it again to those questions of what's happening to advice. We're seeing the advice model change. It's getting, and this comes from McKinsey, becoming a hyper-personalized Netflix-like advice. It's like all of us really streaming at night. What the heck do I watch? What do I push out? What are we getting? What is the customer experience? We can do this in bite-sized advice for the mass affluent, but ultimately, if we look at what is success today, perhaps tomorrow, it's the experience and person-to-person investment advice from an advisor. Of course, also for advice is new entrants coming from strong funding from venture capital, either big tech, fintech, threatening and perhaps capturing market share if the incumbents remain unchanged. And certainly they have the low cost tech infrastructure, but they don't have the experience curve of the incumbents. What about the impact for advisors in the new world or the new normal, possibly from COVID-19? At least, from a strategy standpoint, it could be more coaching of clients. Advisors are really mostly interested in driving the right financial plan, managing assets, and getting attractive returns. But life plans certainly come into this, like retirement. Kathy's going to talk about retirement later. The classic issues as we're getting older as advisors, and the mean average is above 50 years old. Recruiting is bringing in generational changes to the profile of advisors. Advisors today versus 15 years ago, mostly working more in groups or teams. More women and diversity is a plus. Yet it's interesting on this survey done that only 25% of financial advisors have a succession plan. Firms are really sensitive and working with advisors on this issue, whether it be strategic, personal, or just that migration. And then the incumbents, what are they doing? And this really speaks to what I cover with the large banks. They're hiring more technology-related talent. And this is really to upgrade their wealth platforms to be more tech-driven. Did you know that Goldman Sachs, out of their large workforce, over 40% of their total employees are in technology, whether it be for trading, investment banking, or for wealth management. And of course, making strategic decisions as a firm of what are our strengths, where can we win, maybe not being in all the segments, but we'll go over ultra high net worth, and mass affluent. And then coming back to this integrated banking wealth ecosystem, whether you're the incumbent, or we'll even talk about new entrants to this, such as Goldman Sachs. I want to share your pain points. So when we think about technology investing, my observation, it's going in two ways. 4 or 5 years ago, it was really not pretty. But this was a survey even today that advisors, want to run their businesses successfully, hit their benchmarks, but then 61% say it's still what the firms tell us is unrealistic timeframes to scale new platforms and technology. And very often, 79% said there's a lack of integration. It takes time. One of the biggest integration challenges I saw was, I think 5 years ago, when Morgan Stanley acquired the Citigroup Smith Barney franchise, and you had about 2 or 3 years before they finally got it right on platforms. And then there's frustration. I, as an advisor, am running my practice, and obviously for me to execute or to make investment changes, all of the documentation and compliance processing. So the businesses are complex. 2/3 of survey respondents believe that it's complex to processes, and this might delay complete dates or distract me for what I need to do. Let's talk about market segments. And this is really exciting. this conversation on this slide on 14 might be different if we were talking 3 years ago. So clearly at the top is traditional wealth management, broken with those two sub-customer segments. And then we see consumer mass affluent with a question mark, why? Just from the standpoint, because we're all hunters as advisors, assets by average income are the largest for ultra high net worth, which are traditionally global investment banks. And then high net worth is that 1 to 10 million of investable assets. And we'll talk later about the wallet share of that, and sometimes just finding exactly if a customer will share how much of their portfolio is with me or my firm. And then the mass affluent, it's a big opportunity. Each of these on the bottom, you can see the size of these markets are in the trillions. And of course, everyone who's to the left in wealth management is deciding how to be proactive to get the wallet share of the upcoming consumer or mass affluent, who generationally become, as the millennials, eventually they become high net worth or ultra high net worth. And there's many millennials who are there right now on the high net worth. Slide 15, another way of looking at wealth management. So this is technology across market channels. And we have the traditional first column on financial advisors, which is certainly moving away from transaction to fee-based type of accounts, making the relationship goal-based in terms of planning and understanding the investment behavior and needs of our clients. And technology can be used here, but it's still in the early innings of emotional analytics. And that might be, instead of kind of when I was a sell-side analyst, dialing 250 phone calls, technology for the financial advisor can communicate on outbound messaging and custom messaging to their clients, and that's going to grow. And then it gets, especially for the mass affluent market or the consumer market, this mass customization. A number of firms, whether it's Bank of America, Global Wealth Management, have had investment in artificial intelligence and model portfolios, as other large firms are doing. So advisors don't have to spend as much time, unless that's their inherent practice, but preferably so advisors spend more time with client engagement and asset growth versus digging into what are the right portfolios. Workplace. It's become a significant area of opportunity for wealth management. It's one discovered and developed by firms such as Fidelity as a leader in 401k, and just the notion that if I'm an advisor waiting for my client's IRA account, but they're still working, the 401 is getting a bigger percentage, especially during the working years, for contributions for retirement. Asset management, of course, is another part of picking funds for the workplace. Kathy will get into that. And then for life goals or changes of financial health, student loans, and retirement. We then move to an area that was, it's gone from 2 to 3 dimensionals. When I think about self-directed brokerage accounts over the past decade, it was mostly related to the active trader. It was related to the legacy accounts that were transaction driven versus fee-based, but it has evolved as well. We're also seeing self-directed probably having a better foothold into the mass consumer market and offering digital checking and savings. And then, of course, not forgetting the active trader, whether it's Schwab, TD Ameritrade, or others with trading tools. Let's take on slide 16 a case example of convergence of market segments. Why does Morgan Stanley, very large acquisition of E-Trade, we also had Schwab make the acquisition of TD Ameritrade. In this example, when we look at those segments or channels again, Morgan Stanley today is almost one of the best in class large incumbent wealth firms. On my example of Citigroup with the Smith-Barney migration, this firm over 7 years went from operating margins of 12% to today just under 30%. And clearly on services offered with 15, 16,000 advisors, they certainly have a high mind share and wallet of the high net worth and ultra high net worth. E-Trade, on the other hand, a couple surprises. And when this deal was done, Morgan Stanley, James Gorman, the CEO, has a background from consulting. What he saw was self-direct investing was changing. The platforms were becoming more intelligent, and there was an opportunity for more market share. Slide 17 gives you filling in the gaps, comparing Morgan Stanley to E-Trade across, again, the wealth management, self-directed areas, and then the new opportunities that I've mentioned before, both with digital banking and the workplace. And as you look at this, Morgan Stanley is probably looking to the millennials or mass affluent that in time will fit into their wheelhouse, which is high net worth. Another perspective on slide 18 here is someone who has mostly been in global ultra high net worth and in beginning to acquire firms in wealth in the high net worth, which is Goldman Sachs. And Goldman Sachs, which has always had a long perspective, they have always grown organically, certainly leveraging their brand, and they see the opportunity to get into wealth management with mass affluent. And they said, well, what are mass affluent consumers doing? So they initiated on Marcus for consumer banking. By not being bricks and mortar, they could offer more attractive yields on things like CDs. You can see the products on the top, which ultimately lead from spend to borrow to invest. And that's directionally what they would like to see. Additionally, on the market channels, you can see that they are getting a bigger part of the activity of the household or the consumer. And then ultimately, it leads from spending to corporate wealth offering. The value proposition here is very different than to a sophisticated high net worth or ultra high net worth. Ease of use, transparency, using digital and platforms. I want to go on slide 19 and slide 20, a couple trends and influencers to wealth management. The first one, which is trend one, is the sustainable investing. And certainly before, a hot topic was social investing. Kathy's going to get into this and ESG, but with COVID-19, health is another aspect besides carbon and the environment. Trend two is this generational shift. This is significant. This is real. It's the ability to touch the millennial generation. These might be young entrepreneurs of all kinds of businesses who have wealth, or it's that classic investment trust transfer from older to younger generation. Technology, again, plays an important part in that third trend, which is the omni-channel offering for customer engagement. We'll cover that further. And then this hyper level of personalized services, push-pull, what the platform or the wealth firm can do for you as the advisor. Slide 20 are additional trends. Trend 5 is, again, technology by itself. It's almost like when you send 100 emails, do I really need to read this? So the personalization, the emotional analytics are going to play an important part of the client experience, and one that the advisor needs to control. The artificial solutions on trend 6 certainly might give the advisor a chance for more effectiveness in understanding their client experience. Trend 7, again, the API, the Open Application Program Interface, plays an important role, because let's say if you're a leading firm that has traditional segment for wealth management, your advisors, but you're moving into self-direct, you're going to want to innovate or have different content that is the experience in the mass affluent versus your customers in high net worth. And then, of course, all of this is afoul if there's breaches in terms of data leaks. Data security is critical. and it's one way that you can lose customers quickly. Slide 21. Here we're going to talk about the landscape and really who are the incumbent wealth firms, why does scale matter, client servicing to get a bigger share. The investment banks have obviously some strengths, but compared to a couple of years ago, they moved from a B or C game to an A game with a global footprint, employee advisors, and leveraging across the aisle asset management and their technology. The IBDs, independent broker dealers, they're diverse. They're national to regional, yet the trend, when you look at the counts of advisors, is increasingly going to be, at some point, the IBDs will be larger. And of course, they're also large in leveraging technology. Slide 22. I broke it out this way, which essentially is the incumbents are the global investment bank and brokerage. For those firms that have 9,000 to 17,000 advisors, I tucked away in the incumbents, Bank of America, Merrill, Ed Jones, Morgan Stanley, UBS, Wells Fargo. Hopefully I didn't miss anyone there. The expanding wealth would be those who are looking to sizably invest, increase their wealth, and gain wallet share where they have adjacent businesses like Citigroup, Goldman Sachs, JP Morgan. JP Morgan actually wants to be a top 5 player in the US and Europe over the next few years. We already spoke about Goldman Sachs, and Stifel Financial continues to be expanding its franchise and wealth. The online discount brokers and IBDs is actually a diverse group. Some of these are enormously large companies. Sometimes they have different profiles of their portfolio of large businesses. Schwab, of course, with Schwab.com, but also their RIA market. I think they have over 45% market share. TD Ameritrade brings in enormous scale and platforms. Fidelity, we mentioned before in the corporate workflow, 401k, Morgan Stanley with E-Trade. And then, of course, there are incumbents on the left that are creating the, for mass affluent, new platforms with digital, Merrill Edge, Wells Fargo Online. And then there are those moving to the heart of the advisor practice, which is come to us, we can give you these at lower cost. LPL Financial is enormous. They have, I think, 16,000, 17,000 independent advisors, but you use their platform, their processes. Ameriprise, Raymond James Financial Services, Commonwealth. And to the right, probably another discussion another day, FinTech is aspirational of winning share, not arrogant, but certainly feel with a West Coast culture that they can win with technology alone. During the market volatility in the last 2 months, some were not as good as the incumbents. Slide 23. Moving here, and I'll move quickly over the next couple slides. The incumbents really here, to be successful, to target customers with high value advice, you must really have to have bulletproof brand that shows credibility and excellence, strong commitment to the client, use the full firm's resources as an advantage, and enable the platform with technology. Perspective of a mid-size firm that feels that they have strengths and opportunities against the bulge bracket. This is a slide Stifel has used with investors for over the last couple of years, but it really talks about being agile. They do have scale. They acquired KBW, so they have great research, and they feel that they can move quicker than the bulge bracket, although I would say in the last 2 years, the large banks have made strong focus and investment in wealth management. And the boutiques just can't scale quick enough for a fast-changing industry. Slide 25, I'll give you 2 more snapshots about the business. Here we're looking at only the 3 largest banks. You can see that the revenue is significant. We're seeing that recruiting practices have changed. They're mostly looking to keep big producers based on average revenue. And again, the focus is using technology for the new mass affluent market. Slide 26 speaks to more metrics. I won't go through each of these. This was a survey done capturing up to 50 companies. You can see the advisors, and the key metrics is really the average assets under management per advisor, as well as the average gross revenue contribution to the firm. Let me finalize slide 27, bring it back to recommendations, and looking at slide 28. So in our STARS recommendations and also our equity strategy, we have a market weight on the financial sector. We think the wealth management model offers to the large banks and to other firms a great business model. It's high recurring revenue. It's generally not capital intensive and throws off great cash flow. Capital investment where is applied really to the major enterprises, and also not to be remiss of the strategy of trying to retain and grow or be a new entrant to seize the generational shift of wealth management. Our recommendations. It's still green. When I did a presentation like this a few weeks ago, the market was still bouncing off the bottom. We've had a nice bounce back this past week. Banks in particular have begun to rebound, but they still, when you look at the aggregate of this sub-industry, still down about 25–30%. We have buy recommendations on Bank of America, LPL Financial, Morgan Stanley. And for more information about our recommendations, of course, you can go to MarketScope Advisor. Let me give it to Kathy now to talk about asset management, which is another key part and use of wealth. Kathy, good morning.
Oh, good morning. Good morning, Ken. Good morning, everyone. Let's start this presentation on slide 30. I'd just like to discuss a couple of key themes that I'm seeing in the asset management space, and many of my comments are going to dovetail with what Ken has mentioned. But I think first and foremost is COVID-19 and its aftermath is likely to accelerate a number of secular changes that we're already seeing within the asset management industry. And among those is, in all likelihood, there will probably be a, for lack of a better word, a Darwinian thinning of the ranks as second and third tier asset managers find that in an environment marked by a shift to passive investments that they just can't make a go of it. And so my sense is that there will be an increased consolidation. That increase in consolidation is going to be driven by a number of factors, not the least of which will be the need for scale as downward pressure on fees continues, and also diversification, whether it be by product type or asset class. We also do see an opportunity for active managers, particularly as consumers reassess their affinity for index-linked products. I mean, it's great to throw your money in, SPY when the market is going up, but in a correction, people may revert back to wanting higher touch points, more active asset management, and bottom-up, old-fashioned stock picking. The other trend that I really see emerging and exploding in the wake of COVID-19, driven also by generational shifts, is socially responsible investing, which is probably going to emerge as a must-have investment component, coming out from just being a small subsector of the overall market. However, the pervasive implementation of ESG practices, which in the long term is a good thing, is likely to erode the barriers between SRI, socially responsible investing, and so-called regular asset management. And then finally, within all of these secular changes in the asset management space, private equity looks to be a bright spot, largely because they will be on the receiving end of asset inflows as institutional investors look to increase returns in a low interest rate environment. They have aggressively fundraised and have a lot of dry powder and are now entering a market with reduced asset valuations. So let's turn to slide 31. And just to frame the discussion of the asset management discussion, if we look at the worldwide market for ETF, money market, and mutual fund assets, they've grown at a 10-year CAGR of about 7.5%, which is not bad. It's more than double the rate of the growth in GDP. We're forecasting a decline of about 10% of assets in 2020, and then a rise of 15% in 2021. We have to acknowledge that these estimates are being made without a lot of clarity, and the overall growth rates are going to be highly influenced by the timing and direction of a market recovery. One thing, though, is a shift to money market assets will likely stem the decline in mutual fund assets, but it will put downward pressure on fees. So while assets under management may grow for some mutual fund companies, revenues may not grow as fast because of the shift in asset mix. Despite this, equity funds remain a significant amount of the invested asset mix of active invested assets, and this is a pretty standard mix. One thing that we may see change is the percentage of assets in money market funds, which will likely go up to 15 or 16% in the near term. I don't necessarily see that as a sustainable trend long term. Fund flow trends, which when looking at an asset management company in terms of its investment prospects, fund flow is important because asset values can change. It's important to look at underlying organic growth. And so after several years of outfunds, just to highlight on the previous point, mutual funds have had inflows. First quarter inflows were significant, and while this looks to be a promising trend, it's driven by this. The orange bar, if we turn to slide 34, this is Q1 fund flows year to year. The orange bar is this year. And basically, most of the money that went into mutual funds in the first quarter went into money market funds as investors sought safety and liquidity amid all of the market turmoil. The fee structures on money market assets are a fraction of those of equity and fixed income products. So this is going to exert some downward pressure on some of the fund families. ETF investors, if we turn to slide 35, ETF investors stayed the course, however, and first quarter ETF inflows were nearly $72 billion, up from just under $48 billion a year ago. U.S. equities are the bulk of ETF assets, and they represented the lion's share of ETF inflows, and this was particularly true in the first quarter of this year. If we turn to slide 36, again, a somewhat similar mix of assets. Equities represent the bulk of ETF assets. Not too many surprises there. If we turn to slide 37, there were a number, just dissecting some of the fund flow trends so far this year, there were a couple of interesting trends that I just want to point out. Number one was the significant inflow into the VOO that came at the expense of SPY. And this was really a function of investors swapping out one market-driven ETF for another for a cost factor. Some of that has reversed as investors seem to favor SPY for its increased liquidity over VOO. Inflows, there were also some inflows into some short-term T-bill and T-bond ETFs driven by a need for safety and liquidity. One interesting trend, if you look to the right of this chart, is the inflow into ESGU, and that is the socially responsible investing ETF, and I'll discuss that in a minute, but that was an interesting trend that we saw so far and something that may portend a further trend. Turning to slide 38, as I previously mentioned, VOO inflows were really at the expense of SPY. Some of the other outflows led investors to shun some fixed income and emerging market ETFs. Again, in the last week or so, we've seen some of these trends reverse as investors have adopted a little bit more of a risk-on strategy as they try and gauge when the economy will bottom and then recover. One thing to note is the only sector-specific ETF that ranked among the biggest losers in the first quarter was the XLF, as investors stampeded out of the financial sector. Again, in the last couple of weeks, we've seen that trend reverse somewhat. Movement in and out of the XLF is likely to be fits and starts. Another trend that we've seen most recently is inflows into XLY, the consumer discretionary ETF, again, as investors try and gauge the timing and extent of an economic recovery. If we turn to slide 39, this is important because it looks at fund flows relative to size of funds. And again, if you look at the far right, ESGU, which is a BlackRock-sponsored ESG, or socially responsible investing ETF, saw the biggest increase relative to size. Then behind that, the short-term T-bill ETF, BIL, saw inflows 51% of AUM. And then relative to their size, at the other end of the spectrum, were, as we mentioned, Japanese equities, junk bonds, and emerging market ETFs saw the greatest outflows. And again, within sector-specific trends, as we previously mentioned, the XLF. If we turn to slide 40, or actually if we want to skip over to 41, I'd just like to share some industry trends that we're seeing happening in this space. The first one is the likelihood that consolidation among asset managers is likely to increase in the aftermath of this pandemic. The industry has been consolidating for some time. The chart on slide 41 highlights this trend. Many of these deals are very small and off most of our radar. One thing to point out is that so far this year, there was one sizable deal, and that was Franklin Templeton's agreement to buy Legg Mason. That was driven primarily by some activist investors who took a position in Legg Mason and were agitating for them to restructure or find a buyer. My sense is among some of the traditional asset managers whose stock has not performed very well and who continue to suffer net asset outflows, but who still have sizable cash positions, relatively strong balance sheets, and decent margins, my sense is the degree of activism may increase in this space. On the flip side, a number of asset managers may seek out acquisitions for a number of different reasons. As we previously said, scale and diversification, and also to build out capacity. And to echo some of Ken's earlier comments, one of the capacities that they need to build out, and that many have decided it's easier to buy than build, is a tech capacity. So you may see a lot of deal activity sort of outside the core asset management space, but being driven to enhance their tech capabilities, whether it be internal platforms, internal risk management, or external facing platforms or distribution platforms. Turning to slide 42, the ETF space is also ripe for consolidation. What I've put together here is a chart that shows the second tier of ETF providers. So if we look beyond sort of the behemoth, BlackRock, Vanguard, and State Street. Beyond that there are a slew of ETF providers. At the top of this heap is Invesco and Schwab, two firms that have made great strides increasing their presence in the ETF space. In the case of Invesco, that was done through acquisitions. If you look along this list of companies, you see some fairly large firms without a great presence here. My sense is that firms like JP Morgan, Goldman Sachs, who want to increase their presence in the wealth management space will probably start to make a move in the ETF space one way or another to increase their presence here. And so this area may see a consolidation. And then beyond this are literally hundreds of much smaller firms. And they too will likely, our sense is, consolidate. Turning to slide 43 and picking up on a trend that I mentioned earlier, socially responsible investing is going to continue to gain traction. It's going to be driven by a number of factors, not the least of which is demographics and the relative favorable performance of ESG sanctioned stocks. And then also the growing scrutiny of how companies handle this pandemic, how they treat the welfare and the health of their workers is becoming a big issue, and that actually could put some ESG darlings at risk, and I'll explain that in the next slide. But the rise of ESG assets, they've grown at a CAGR of 14%, which is a very healthy growth rate. The risk here is that the value proposition is diluted by the fact that so many companies adopt ESG guidelines. Here we see an advantage among active asset managers who have the ability to increase their SRI moat by implementing either impact investing or activist investing along with an SRI model. To illustrate the point of a questionable value proposition, turn to slide 44, please. What this shows are two funds' top 10 holdings. One of them is the ETF that I mentioned, the ESGU, the iShares ESG ETF. And the other one is the American Century Ultra Fund, a fund that's been around for nearly 50 years. If you look at the top holdings, they're very similar. To answer my question, because you're all on mute, the ESGU portfolio is on the left. Interestingly enough, they have an energy exposure in their top holdings, but American Century Ultra Fund does not. So I put this up to just illustrate the point that the value proposition for ESG funds becomes a little questionable. However, if you look at the names up here, you can understand why the performance of these funds has been so favorable. Now, the other point is, in the wake of the pandemic, I think consumers and investors are going to be looking at how companies treat their employees. If you notice, Amazon is a top 10 holding here. I think something like that could be vulnerable if investors perceive that Amazon is not treating their workers fairly or is concerned about their health. My sense is they're going to make great strides to correct some of these perceptions. Turning to slide 45 to echo my previous comments about the positive secular growth trends we see in private equity. At the end of last year, private equity had dry powder or uncommitted capital available for future investments of nearly $1.5 trillion. Coming into this year, before the pandemic, one of the sources of frustration on the part of many firms was that asset values appeared inflated, and there was not a great deal of concern, but some concern about being able to deploy that that uncommitted capital at valuations that were going to be attractive. Well, the pandemic took care of that, and our sense is that private equity will be relatively active in the marketplace deploying that capital. Our positive outlook for this space is driven by the fact, as we previously said, in this low interest rate environment, institutional investors like insurance companies, for example, need to increase their investment income. It's very difficult to do that with fixed income investments in this rate environment. And the mixed performance of alternatives has led many institutional investors to increase their allocation to private equity. Our sense is that in this interest rate environment, that is likely to continue to increase fund flow into private equity firms. In terms of the source of their targets or where they tend to make their investments, slide 46 highlights the fact that technology does remain a core focus for a lot of PE and venture capital firms. And we expect that trend to continue, but we also expect a number of more opportunistic funds to focus on some areas where there has been a fair amount of disruption, and that includes the healthcare space, the energy space, and some of the industrial sectors. Some of the publicly traded PE firms have also mentioned an interest in logistics, in telehealth, and in life insurance and annuities. All three, again, are also either highly sought after areas or areas that are in the midst of a correction or disruption. Turning to slide 47, I wanted to talk a little bit about the retirement savings crisis. And it's interesting because there are some metrics that look like financial picture for retirees or soon-to-be retirees and is improving, and others not so much. And my sense is in the aftermath of this pandemic, you're going to see a bifurcation in this country on a number of levels, not the least of which it will play out in retirement savings. I'm sure many of you have seen this pyramid in terms of retirement savings resources. Three things I'd like to point out. One, defined benefit retirement plans, given all of the stresses on state and local governments, which have a large share of these pension liabilities, that's one thing to look out for. Unfunded liabilities could approach $9 trillion by the end of 2020. Then the second thing is IRA assets have grown at a CAGR of 10%. This is the first time in quite a while that it's above the rate of healthcare inflation. That's actually a positive trend. And then finally, and I don't think that this is a trend that is sustainable, but it's an interesting little sidebar. The U.S. savings rate was 7.6% in 2019. In the first quarter of this year, it shot up to 13.1%. Now, as the pandemic eases and people resume their normal activity, my sense is that that savings rate is going to go down. But that's an interesting metric to watch in terms of consumer spending and consumption and what shifts there may be in that, or what changes there may be in those patterns as a result of this pandemic. Turning to slide 48, again, within every crisis, there's also an opportunity. These numbers have not changed materially, and this speaks to the continued void that remains in terms of the percentage of the population and their need to save for retirement. And that is, I think the one takeaway from this slide is that 37% of U.S. households have neither an IRA or an employer-sponsored plan, which means they're going to be dependent on Social Security or personal savings. Turning to slide 49, U.S. retirement assets. Again, the growth here has been fairly decent. Our sense is that in 2020, you're going to see a decline of about 1.2% and then a rise of 16% in 2021. Similar to our forecast of other assets, the direction and the timing of these changes are going to be impacted by the degree to which asset values recover. And then finally, on slide 50, challenges and opportunities within the retirement savings market. So in terms of preventive or factors that prevent people from being able to save, student loan debt is probably the most significant and most common roadblock. So, you know, at the end of last year, you saw student loan debt was about $1.5 trillion. 11% of loans were past due or in default. Our sense is that number is going to skyrocket in the aftermath of this pandemic. The one interesting thing is that those firms who have offered to refinance or have refinanced student loan debt tend to have first mover status in terms of offering financial advice to the student loan holders. And it's an interesting entree into the retirement savings market or the advisory market. And this is for the sort of the mass affluent or the more middle market client. Again, access to retirement accounts. The Secure Act aimed to address those issues. With everything that's gone on in the pandemic, there hasn't been much focus on increased access to 401ks. I mean, given the escalation in the unemployment rate, I don't think that's necessarily been a focus. And then the CARES Act did a number of things that will impact the balances, not the least of which suspended RMD. So that's going to shift some of the asset flows in that space. And then in terms of general and demographic shifts, and this is significant, during the market volatility, a number of robo-advisors had outages. Our sense is that the affinity for robo-advisors might be waning. This doesn't mean that consumers of advice don't want a streamlined technology interface. It means that the value of an advisor, a human advisor, has probably increased in the aftermath of this pandemic. An interesting little factoid for you is that I pulled this out of a survey. I don't remember if it was the Investment Company Institute or the Financial Planning Association, but less than 20% of affluent millennials are comfortable working with a robo-advisor. And indeed, what we've seen is that as millennials age and become more affluent, their consumption of financial products more closely resembles that of baby boomers, which is actually a good thing for advisors. And then the other thing that's driving a lot of this is that we're on the cusp of the largest transfer of wealth in history that's set to occur. ESG compliance will drive a lot of those preferences. I saw a statistic that says something like 68% of the assets set to be transferred are not ESG compliant. So that is a big factor, and it's going to influence investment decisions and advisor decisions by this new generation of investors. So, recommendations in this space. If you turn to slide 52, these are my recommendations. We as a firm are neutral on the financial services sector. A low interest rate environment and some eroding credit quality removes a catalyst from a number of areas. We do think there are selective names that have held up in this environment and whose shares have a catalyst. This list of recommendations consists of either top-tier active asset managers like T. Rowe Price or Eaton Vance, private equity firms that we think are poised to outperform like Apollo and Blackstone, or market leaders like BlackRock, we upgraded our opinion on BlackRock after PNC announced it was selling its stake. We just saw that as a near-term opportunity to get into the shares of a market leader. And then finally, State Street, another market leader, we upgraded to buy when it appeared that their restructuring actions were starting to take hold. So those are the recommendations, and I'm happy to turn the microphone over to Ken if you have any questions.
Thanks, Kathy. Great job. So we're going to go in rapid fire, given that we're just past the hour. There was one comment that came in, and actually with a good explanation, that many firms, large or small, do have different affiliations, and for advisors, especially for retention, to build market share, there are examples noted, such as Wells Fargo launching an RIA channel plus FiNet, Raymond James acquiring Alex Brown and having multiple affiliations, IBD or the employee channel. I mentioned on the call LPL Financial. So sometimes using different approaches to retain advisors, and of course, Schwab is the dominant one by far in the RIA space. Here's a question where I don't have a precise answer, but it's a great question. Are you seeing an uptick in advisors using behavioral finance to account for investor bias? This is a growing new field, which essentially some of the large firms are trying to use artificial intelligence or ways to help advisors with some of these, if you will, deadly sins of behavioral finance. Some examples of that would be confirmation bias, where you continually make common mistakes with investor portfolios. The familiarity bias, you only invest in what you know. Another one, generational, a big part of our presentation. Young investors might have a loss aversion bias. There was recently shown that the millennials were not necessarily ready to jump back in the market as much as baby boomers in the last couple of weeks. And it's a great topic, probably a future presentation will be great. Let's move to slide 54 to wrap up. First of all, we want to thank everybody for their precious time on today's call. There are upcoming webinars. June 4th is the consumer losing steam. And then on June 17th, playing defense in a volatile market. Two really fascinating topics. Obviously, to get more, not only about the webinars, you can see the website there for advisor, marketscope.com. So we're really happy to have presented on today's topics. If you have further questions, do not hesitate to reach out to us. And thank you for your time again. Have a great day.